Good day, Industrial Advisor listeners, and thank you for tuning in. If you have not subscribed, please do so by clicking subscribe wherever you podcast. Click the like button and hit the bell if you want notifications of when we put up new content. Leave us a comment about anything we discuss here today or general comments about the show. Now, let's get into it.
Welcome to our Industrial Advisors podcast. You have Bill Condon and Matt McGregor. And today's topic that we're going to dive into are the top 10 trends we're seeing right now in industrial real estate. So Matt, lead us off. Talk about the first couple.
Absolutely. The first one here is green goals, green initiatives. As we know, there's been massive conversions and goals and laws and regulations made over the last several years to go green. We haven't seen it in warehouses, but there is legislation in Washington that is beginning to change things, including, I believe, starting this summer, all of those heat protection units, for example, can't be gas-powered anymore, and the speculative buildings are going to be electric. I'm sure we're going to start to see some solar power stuff and then other initiatives coming down the road. And it's not even an initiative, it's going to be a requirement, is to make these buildings adaptable for not only electric vehicles, but more importantly, electric trucks, right? So we are seeing the first speculative building on the old Sumner Golf Course with Principal Global Investors designing that building, both the 450,000 foot plus or minus and the million footer, to accommodate all of this, right? So we're going to see a lot of this. It'll be interesting to see how quickly it adapts, but we are seeing rules even in Washington change now.
Yeah, we've talked about this, but a little surprising that we haven't seen more buildings built to that kind of spec. But I think we'll see it go forward. So talk about another one, another trend.
Yeah, the other one that we're seeing a lot is credits and incentives. And as we, obviously these are typically in more downturns. Obviously, we're not in a downturn, but if we slow down, I think we'll see a lot more of this. But you see it, Bill. I mean, every day our requirements are getting more sophisticated. You have a lot of requirements requiring FTZ, free trade zone status. There's a tax abatements, even in Washington, which historically has not been a state that has a lot of incentives. There are some out there now. Certainly, there's a lot throughout the U.S. You know the areas, Kentucky, Indiana typically has a lot. The Southeast has a lot. But we are seeing a lot of different types of credit and abatements for training. Obviously, enterprise zone over the last few years has been huge related with the credits there. But I think this is a growing trend that you're seeing even in competitive states like Washington, California, that historically doesn't have them.
Certainly. That's a really good point. Another trend we're starting to see is market stability. Obviously, in 2022, that debt increase had a really big impact, specifically on the investment market.
In a crazy way.
We're starting to see more investors come out and ask about, saying they have money to place. I think that after a very kind of quiet first quarter on the investment side from a volume standpoint, we're going to start to see the second half of the year pick up quite a bit from a volume standpoint on the investment side. Leasing's been strong throughout, so that hasn't been impacted. That's continued to stay strong.
Which is a crazy dynamic to your point, to say we're arguably at the lowest vacancy of our career and falling.
Yep.
Yet buyers are nervous. Like, that's weird. And we're seeing the biggest rent growth of our career, but buyers are nervous.
Yep.
Right? They're nervous mainly because of inflation and interest rates, right? So I don't think the bank failing, this recording is probably going to be, so the bank recording, say, 4 weeks ago in Silicon Valley is going to cause further disruption in that. But I personally think, Bill, and it'll be interesting to look back on this year, I think the buys happened that we'll look back and say those were great buys. Q4 2022, Property Reserve and LaSalle. And I think whoever buys in the next couple of months, because you've had sideline money for a year now building up, people are going to have to start buying, which is going to cause them to be more aggressive. So I think the people that are out in Q2 of 2023 are going to get the best buys.
Yes, I agree. I think that as volume picks up, cap rates will start to come down again. But yes, I think there's a nice window right here where there's going to be some quality pickups.
That's right. And then let's talk about tenants, because we saw through COVID just crazy, right? Absorption numbers in Washington, well, throughout North America, absorption was crazy, right? Inland Empire had a 40 million foot year, but Seattle had, through COVID, the two biggest years, 10.6 and 10.2, was it, million feet?
I think it was like 9 something last year, but right
Yeah.
there. Yeah.
But 3-4x normal, which was like 3.2 million prior to COVID. And at the end of last year, we had like 5 or 6 million footers in the market that all disappeared, right?
Yep.
And now they're starting to finally trickle back. So, I mean, we're seeing activity across the boards.
Yeah, absolutely. So there are a lot of corporate tenants that are out there ready to go again after hitting pause. So I think we'll see some more of those big deals happen. The other trend that we're seeing is a flight to quality. And an example of that is, I think, the Kent product that was built. We hadn't seen a bunch of new product in Kent just because there wasn't any land that was available. And that stuff leased up really quick at high rates. And so you're seeing tenants willing to go to good quality buildings in good locations and being willing to pay for it.
That's right. I mean, that was record lease up in Kent. And Kent, by the way, last year that was the first big wave of new construction in Kent we've had in a very long time. All of it mainly got absorbed that was finished. I think it was 2.6 million feet in Kent, and it was the number 2 absorption market for 2022. And I can't remember, I mean, how long do you think it's been since that was number 1 or 2 in absorption? 20 years?
Yeah, it might have. It's been some time, maybe since that 212 stuff was built.
Maybe then,
Yeah, which was
some product
probably
there.
15 years ago. Or whatever.
Yeah.
But a big part of that is just the fact that you haven't been able to build there because all the land's been taken.
And to your point, is a flight to quality. So that market is dominated by 24-foot clear 1980s vintage buildings with a 100-foot truck court. So to get these 32, 36-foot clear buildings, nice truck court, shiny new look, all of a sudden we're seeing $1.20 shell rates, which, what would that have been pre-COVID?
Well,
68 cents or something?
Yeah, because the first deal they did in that Kent Park was done at 82, and then on the shell, and the last one they did was $1.20. So there you go.
Crazy, start to finish.
We touched on this a little bit, but another trend is just transaction volume is going to increase. Again, slow first quarter on the investment side because of where debt's been, but we know that there's capital out there. We're going to see a much stronger second half, I think, in core markets across the country from an investment standpoint.
We definitely will. You and I know, every day we're getting calls, requests for meetings as these funds are coming into Seattle, wanting to understand the dynamics, wanting to find opportunities. There's really not much out there to buy, but boy, is there pent-up demand, and that will be very interesting to see it play out. I got a question for you on that. Nationally, we hear about all this stuff of, developers pulling back, saying, nope, we're not starting this construction. We are not seeing that in the West. On land, what do you think our core market land has held in value? You still think it's 100% of what it was at the top of the market? Where do you think it is?
No, I don't think it's 100% just because of where debt's at. That's had an impact on how those are getting underwritten. Mm-hmm. So rents are still getting underwritten at a very high level, right?
That's right.
Those have not come down, but because of the debt factor, I think land in the core markets, right, is probably down 10 to 15%, but not a ton.
Yeah, that's a good point. We'll see some land trade this year, some stuff that's out right now, so it'll be interesting to see where that trades. I agree with you. It's not 100%. What about the South Sound? Maybe even take it into, Frederickson to Tumwater areas. What do you think the decrease in value in land is?
Yeah, so I think in more secondary type markets, as you go further and further south, one, there's not as much of an appetite to go to those markets, right? They're a little bit more caution. But I would say that's closer to like 25, 30% as you get into secondary markets. And if you're talking, from a national standpoint, if you're talking the Midwest, right, I bet you land there is closer to 30 to 40% off the peak.
Right. Good point. What about rent growth? I mean, you and I both know it's been crazy double-digit rent growth for several years, and I'm talking up and down the western region and even the eastern seaboard. A lot of key markets have been double-digit rent growth. With everything that's going on, what's your prediction for this year and maybe over the next couple of years? Are we going to continue to see that trend?
Yes. For markets like the Puget Sound that we're in, where your vacancy's low, your fundamentals are super strong because you don't have a lot of land that's left, right? We're not overbuilding. We have 5.5 million feet under construction, in our market right now, we're going to absorb more than that this year. So in markets like the Puget Sound, the Inland Empire, New Jersey, some of the markets in Florida, yes, rent growth is going to continue to go up just because the fundamentals support it.
That's right. And what about absorption? I know our Q1 report and predictions podcast, I think you said 7 million feet.
Yeah, I said 7.5.
You said 7.5.
Yeah.
I think I said 5.5.
Yeah.
Okay, so we're through a quarter. I think you're winning this bet.
Yeah. I think I was low.
You might have been. I don't know. I mean, I think it's going to be closer to your number, but I don't think it's going to be over it. I think we're probably, if you ink what looks like it's going to be done, I think we're going to have about 2.5 million feet so far. So if you times that by 4, obviously it's going to be, but I don't see that. But I would favor your number over mine at this point.
I think that if a couple of these larger deals happen, which they will, we think, right?
Yes.
All of a sudden you're halfway there.
Right.
And that's not even counting the bread and butter of our market of, call it the 300s that are going to get done. So anyway, I'm feeling very bullish on my prediction.
Very good. And let's talk construction starts. I indicated this earlier that a lot of the, markets in the U.S., those construction starts are saying, whoa, we're not getting, financing for spec construction. Interest rates are going up. These numbers don't work anymore. Let's shelve this project for a couple of years. We're not seeing that here, and we're not seeing it west, right?
Yeah. I mean, in the markets that support it, in the core markets, they're going to continue to go, right? No one's hitting pause. I mean, if you have a building if you pull it into our market, if you have a building anywhere in the valley, Pierce County, you're not pausing, right? You may, if you get further and further south as you get into more of a secondary market, then you might hit pause. But nowhere in between Tukwila and Tacoma is anyone hitting pause.
Do you think they're going to push pause further south, like in some of those markets like Winlock and South, Kelso and Centralia, where people are saying, hey, we're going to build spec? You got, Exeter and Crow Holdings and others down there saying, we're going to go spec. Do you predict that?
I think that it wouldn't shock me if some of those groups went and started waving the build-to-suit flag rather than the spec flag, right? You may see some of that in some of those type of markets. Last one, though. Let's talk about the port.
You're not going to like this, Billy.
Yeah. Talk about the
Billy
port.
doesn't like anything negative.
Yeah.
So this is not good. So the port statistics are a little crazy. There's pretty much the entire west coast of the United States is down over this last year. Seattle, Tacoma, which is the 4th most active port in the U.S., down 16% year over year.
And you're talking volume?
The total volume.
Okay.
TC volume. Port of Los Angeles down 18%, and then Long Beach 21.8, almost 22%. And then here's the big surprising numbers: is you had a huge jump in our ports competing with us. No surprise, the largest port in Mexico up 11.3%. We had a lot of nearshoring, right?
Mm-hmm.
So now they're coming out of China and saying, hey, we're going to manufacture close to the border. They're bringing everything in that. No surprise on that one. This is the big surprise. Prince Rupert is crushing L.A., Long Beach, and Seattle, up 23.3%. And then the whole eastern seaboard is up. So New Jersey up 5.5%, Norfolk 7.5%, Savannah 5%, and then a couple of other small ports. But East is killing us and Canada's killing us. So that'll start to play out on the West Coast if all of a sudden we're not getting that freight. That'll impact warehousing.
Yeah, it definitely will. Fortunately, in a lot of those markets, fundamentals are still strong, so we'll see how much of an impact it has, and hopefully the volume will increase.
That's right. Well, thank you so much for tuning into the show. We greatly appreciate it. Thank you very much.
Thank you.